Well, hi, it's Chris here from Capital Counts and welcome to another one of our Meet the Fund Manager Investment series. Today I'm kindly hosted by Plato Investment Management. They were established back in 2006 and manage over $15 billion. They've got 15 investment specialists, 4 of them being PhDs and specialise in both global and domestic markets. Today, fortunate enough to be hosted here by their founder and Chief Investment Officer, Dr. Don Hamson. Thanks for having us, Don.
Thanks, Chris.
The Australian economy. Clients are certainly worried about the Australian economy and perhaps a recession. In fact, from a recession perspective, we might already be in it on a per capita basis, but what are those concerns valid?
Well, I was around in the recession we had to have back in the 1990s, which is probably the true last recession we had. There was a technical one in the sort of pandemic, but doesn't seem to me like there is a recession. I know a lot of the economies are doing it tough. Younger people are finding it hard to make repayments. Arrears are increasing. There's a lot of negativity on TV. But on the other hand, a lot probably of your older clients are actually doing okay. Their house prices are up, the share prices are up, their term deposits are up, and the spending patterns from Commonwealth Bank, which were released in its recent results, were that they're spending as much or more than ever, both on things they have to spend on, but particularly consumer discretionary, which is travel and eating out and those sorts of things. But it's the younger people that are feeling the pain. So it's sort of a lot of the economy is doing okay, but also a lot of people are doing it tough, that's for sure.
But it's the two-speed.
Yeah, two-speed economy, bifurcated, whatever you want to call it. But you're not seeing bad debts in the banks. So the other thing about the Commonwealth Bank result was, and it was echoed in the quarterlies and recent results from other banks, was very low levels of bad debts, lower than last year actually. Arrears are starting to rise, but there aren't bad debts. So partly because house prices are going up, banks are being more accommodative. I think if you go to them and say you're under hardship, they'll restructure and those sorts of things. But it's clear, yeah, that it's a two-stage economy, but I don't think we're into a recession, because really to be a recession, to me, you need to have high levels of unemployment, and unemployment's not that far off lows. So most people who want a job can get a job, the gig economy, that sort of stuff, and yeah, people are doing it tough, but gee, I tell you what, I had 2 jobs, in fact, 3 jobs, I think, in back in like 1990, 91, when interest rates were 18%, you know, that was a tough time, but unemployment got to like 10%, not 4%. So to me, the economy is still, look, it's not strong by any stretch of the imagination, but, and as you've alluded to, the glass half empty people will say on a GDP adjusted for the number of people in the economy, it's actually going slightly backwards. GDP is still slightly positive on a total basis. But I'm reasonably confident that we'll avoid a recession, and in fact very confident, and I think the next move in interest rates is going to be down. We saw a good inflation number, albeit due to electricity rebates and things to a large extent, but we did see an inflation number, headline number, that was below 3% today, and that must make it a little bit easier for the RBA to cut rates in the near future.
How are you feeling post the reporting season? What insights can you share with us from that?
Well, the actual reporting season was okay. It was better than expected in terms of if you look at the numbers and the companies, you know, on earnings numbers and dividends, they're actually slightly better than analysts expected. And in sectors such as consumer discretionary, in some cases, are much better than expected, because people were thinking it was going to be even worse, and it wasn't. The outlook statements by companies were a bit soft. You know, they're worrying about the US elections, which to me is a bit of a furphy, because I don't think it really affects us here that much at all. There's a bit of concern about when interest rates will come down, but I think after today's number that makes it a little bit easier to go down sooner than later. So yeah, it was sort of mixed. Dividends actually were, well, the average company, we focus on dividends because we run a dividend fund that, you know, is paying out high levels of franked income to clients, and we get that from, or to your clients, we get that from the dividends that companies pay, and the average company actually increased its dividend by 7%, and the median company, which is if you rank all companies paying dividends from best, highest to lowest, The one in the middle increased its dividends by 5%. And that means more than 50% of companies increase dividends, 58% actually on our numbers, which is higher than the inflation rate. 5% is higher than the inflation rate. So that's not bad. However, the glass half empty people will say, well, actually the dollar value of dividends was a little bit lower than last year because one big company called BHP had about a 13% cut in its dividend. That pulled the total numbers down. But virtually, like year on year, we're paying about the same level of dividends, which is a pretty high level of dividends.
I was going to ask you around dividends, but maybe some commentary around the banks and their dividends and what's actually driven those stock prices to these record highs.
Well, there's a lot of debate about what has driven the bank stock prices, but what I would say is that it's a global effect. It's not just Australian banks, not just CommBank and Westpac that have rallied significantly. If you actually look at the rally in banks over the last 12 months, and it's been something like 25%, that's just mirroring what other banks in the US and Europe, etc., have gone up about the same amount. So it's a global effect, not that. And I think one of the reasons, and I don't think you can prove this, is around the world the expectation is that the next move in interest rates is down. In fact, and that's been the case for almost a year now. And you've had the Federal Reserve cut interest rates 50 basis points last week, so that's positive. The European Central Bank has already cut interest rates. Canada has, so you are seeing the major economies are now clearly going into interest rates down. So we're actually against the trend by still holding interest rates up. So I think our next move has to be down. I think very hard for the RBA to raise rates when everybody else is cutting rates. It would impact the dollar and other things. So what's keeping? I think one of the reasons that the bank share prices have rallied so much is because we go back 12 to 18 months ago, there was a lot of negativity about banks. There was this thing called the mortgage cliff. There were all these people that had borrowed at very cheap rates, often fixed them, and last year a lot of those rates rolled off and they had to roll from a very low, like 2 or 3% loan to a sort of 6% loan, which is a huge increase in your repayments. Yet the bad debts of the banks haven't changed. And I think that's the issue is bad debt. The banks aren't having bad debts. And so whilst people are doing it tough and might be scrambling to make those repayments, when your house price is going up and when you've got a job, you keep paying as much as you can on your mortgage. You don't not pay it. So I think the fact is there are a lot of strategists extremely negative going, there's going to be all these bad debts for banks. It's going to be huge arrears. House prices are going to fall. And they got it totally wrong. House prices have kept going. So banks are a little bit, because they are so leveraged to house prices. If our prices go up, it's good for banks, so bank prices have gone up. But I'd say it's a global phenomenon, not just Australia.
Retail sales as we head into Christmas?
Well, look, that's a lot to do with sentiment from individuals. We are seeing tax cuts coming through. Petrol prices are down, which is probably good because people can maybe afford to spend a little bit more on others. We're getting these rebates for electricity, etc. And I don't think it'll happen. But if we had a surprise first cut before Christmas, that might augur well. I think it's still going to be a pretty tough environment for the retailers. But the reality is, stocks like JB Hi-Fi and Super Retail Group have been great stocks for us, and they've actually managed to perform very well in this environment. So it's the retailers that have been able to innovate and are fast moving and those sorts of things. And Peter Alexander within the Solomon Lew's group is one that's doing well. Some of his other divisions not so well. But some of the retailers have been able to position themselves and do pretty well in this environment.
You mentioned a couple of stocks, but are there some favourites or sectors that you
well, those are a couple of names I've mentioned. The two that are listed in their own right have been great stocks for us and still rank very well. We still they'll pay reasonable dividends. JB Hi-Fi paid a big special in the reporting season, which is good. So did Woolies actually, but Woolies' sales are a bit sluggish, and obviously a bit of a negativity around sort of inquiries into Coles and Woolies and price fixing, etc., or mis-selling their prices are down type stuff. But we also like some of the financials, some of the insurers, and I know people own get the next premium from their insurer, and it's usually up 10 or 15 or 20%.
Sometimes more.
Yeah, sometimes more. Well, if you own the insurers and that companies are actually doing a bit better, they're investing at higher interest rates, at the moment. So the outlook, they've had big increase in dividends. So they still look pretty good to us. A bit softer in the mining area. Obviously, iron ore prices are down, although there's been a bit of good news from China in the last day or two. The lithium down, nickel down, but copper's still reasonably strong, and the real standout has been gold, and there's a couple of little gold stocks that rank very well in our process.
I want to talk a little bit about your fund.
Yep.
Obviously, income is really important, obviously, to our clients. Capital growth's important, but what are some other considerations that clients should look at? I've been using your fund for some time. It's purpose-built for retirees with the franking credits, which you'll probably tell us a little bit more about.
Yep.
But how do you do that, and what are some of those things that investors should consider when just not looking at income but capital growth? And
yeah, well, I think, our fund's called an income fund, so clearly it's targeting higher income than if you're just in the market or something. I think investors should look at the regularity of that. If you're in an income fund, has it been consistent over time, consistently higher income, or not just big in one year and pretty average the next? And we've been able to consistently generate a lot more income than the market. But it's not all about income. A few of our competitors have struggled because they've been able to generate income, but their total returns have been pretty poor. But my view is if you hire or invest with an active manager, you pay a fee for us, we should be able to outperform the market over time. And thankfully, we have been able to. So we have a dual objective in our fund, which is firstly, at a total return level, probably most important is outperform over the longer term. There'll always be a year when you won't, but outperform over the longer term, and then income is obviously clearly important, particularly for retirees. You don't have a salary anymore, so you want that regular income, which is what I talked about before. So, and I suppose for us, our fund, we are Australian Equities. We get those great franking credits, and it's it's not just the cash dividends you get, but it's that refund that you get when you do your tax return. So you've got to factor that in. One of the problems, I suppose, with a managed fund is you might just look at the unit price and say, okay, it's going okay, but it's not fantastic. But if you're generating 8 or 9% income and paying that out when you include the franking credits, that's a pretty strong return in itself.
So what's the Australian market paying at the moment, fully franked?
Well, that's probably the negative. The negative thing at the moment is the Australian market's really trading at a record high, and so yield is a function of dividends paid divided by price, and if share prices are high, the yield will be down, and it's actually trading at just over, I always talk in gross terms, so cash dividend, which is actually just a bit under 4% plus about 1.3% franking. So the yield on our numbers is about 5.2 at the moment, which is as low as it's been, apart from the pandemic year, as low as it's been in sort of records, and that's because your share prices have gone up a lot, and to some extent because dividends haven't grown in the last 12 months, but share prices are up quite strongly, particularly the banks. And so that's not as great, but we've been able to generate around 3% more than that number.
Right, which is a good number.
Yeah. And I think 8%'s pretty good, and in fact our long-term record's 9%, but we're a bit less than that at the moment, given that the market yield is lower than normal. Yeah,
so that was the income, but so the capital growth component, how have you performed?
Well, if you look at total return terms, so income plus capital growth, we've outperformed the market. We've given a lot more income than the market and a little less capital growth, but we have had capital growth. You add them two together and we're outperforming after fees.
Excellent. Okay. Well, Don, thank you very much.
Thanks, Chris.
To all my listeners, if you'd like some additional information on Plato, please give us a call on 1300 882 166, and look forward to catching up with you next time. Thank you.